Hey guys, JC Perez here, founder of AllStarCharts.com, and welcome back to our options trade of the week. I am joined by my main man, my esteemed colleague, Mr. Sean McLaughlin. Sup, Shawnee? Are we back? Are we here? I think I lost the audio. Sean, you're on mute. Unmute yourself, Shawnee.
Oh man, how did that happen? That's weird.
I don't know. Amateur hour. We were just talking about how good we are at this,
Well,
right?
you and I were literally just talking right before we went live. I don't know how I got muted there. That's weird. But anyway, hey, we're the two people who are not impacted by hurricane right now. How wonderful is that?
That's right. If a hurricane's in eastern Pennsylvania, I'm in trouble. And if a hurricane hits Denver, whoo,
We got problems.
we got problems. We got problems. Even though if it hits Denver, I guess if it hits Denver, it's hitting Boulder too. Listen, we came into the last few weeks thinking, all right, we got a little bit more volatility than we're accustomed to. We're different things are working now than we're working before. So we're selling some premium. We sold some premium in Freeport and also in Microsoft. Sold puts last week, and then Freeport the week before that. Coming into this week, I feel like I was more open-minded, not necessarily so like focused on we have to sell premium. Kind of like, all right, what are you seeing out there? You came right out of the gates with Google. We were talking about some of these technology trades. I think somebody mentioned Apple, and I'm like, well, if we're going to buy Apple, why don't we just buy NVIDIA? And then Shawnee, baby, coming in hot. I like Google the best of all of them.
Well, I just felt like if we're gonna dip our toes in the water on the long side right now, I mean, you got to go with the leaders, right? And the Google chart, I don't know if you could bring this up on the chart on the screen right now, but the Google chart, man, you gotta love the way that really didn't pull back all that aggressively during this recent market correction, and now it's poking its head up above the summer highs. I mean, leaders are gonna lead, right, JC? And Google is showing the signs that it wants to be one of those leaders.
Yeah, I think Straza said it like, you're buying one of the strongest companies, you're kind of thinking it's kind of like added fuel behind that. Like you're buying relative strength. The target is we get back to those former highs. The risk is we lose the recent highs from, say what, August, like the August lows. If we lose those, then Google's probably in much bigger trouble. Growth is probably in big trouble too, for that matter. But the upside is, although I think we probably go much higher than those former highs from late 2021. For an options trade, I like that strike, right, as that next target.
Yeah, so you were liking the option the 150 strike. I threw a higher strike out at you because I had like the 25 delta, but I do like your reasoning of the 150, and then we threw into the mix like, hey, well, why don't we sell some puts to finance the trade? We could sell right below. We could sell a strike right below that level that we're leaning against for risk management. So why not? Let's position ourselves for Google to make a run. Let's give ourselves some time. And we looked into the March option series, and hey, the way it worked out, the way we were able to put the trade together is we were able to buy the 150 calls and finance a large portion of the purchase of those calls by selling the 125 puts. It still costs us $2 all in. So there is a cost to this trade. Usually when we do risk reversals, we like to do them for a small net credit. But in this case, we're selling, or in this case, we're buying calls that are a little closer to the money than I would normally do when buying a risk reversal, only because we like that level. So it's going to cost us a little money, but that's okay. If as long as Google doesn't go below 125, which is kind of our line in the sand, then the worst case scenario is we lose $2 on a bullish bet through March, which I feel like is a great great risk to reward scenario.
Yeah, so let's walk through this. So, okay, so we're bullish Google. We think it gets back to those former highs, and we're thinking about just buying the calls because they're not that expensive, right? But they're $7.45 for those calls, right? These are the March 150s, and that strike price just happens to be the former all-time highs. Not a coincidence. That's by design. I like buying the strike. So does Sean, for that matter, at those former highs, but it's not the 25 deltas. The 25 deltas would take you to 160, so
Right.
they're cheaper, and it would be potentially a slight net credit or a slight net debit on the trade. But in this case, nevertheless, $7.45 for those March 150 calls because they're closer. We don't necessarily have to pay for all of that trade by selling the downside puts, but we can get a nice chunk out of it to make it a $2 net debit. And at the end of the day, if we lose 125, those are the puts that we're selling. If we close below that at any point, all bets are off. And we don't want to be long anyway in that scenario. So even though that's the proper risk management strategy, because we're selling the 125 puts, so at any point that closes below that, you unwind the whole thing. Even if that wasn't the case, I still wouldn't want to be long Google if we're below 125. So that works out perfectly.
Yeah, you're absolutely right. And look, I mentioned before, this is not typically the way I do a risk reversal. I like to do a net credit, generally a small net credit on the trade. One other thing that I'm doing a little bit different in this trade, JC, and perhaps I'm being a little bit more aggressive, but if we break through 150, and that's the long call strike, I will take some profits off the table. I'll probably sell half of my calls, but usually in this scenario, what I like to do is I like to sell half of my calls and take all those proceeds and cover my short puts. In this case, I'm just going to leave the short puts alone. If we get to 150, I'm not going to be worried about those 125 puts. Seems kind of silly to worry about those. So whatever premium is left in those puts, I'm just going to let that theta decay work in my favor, and I'll just keep riding that position. And look, if I sell half of my position above 150, and worst case scenario, Google rolls over and comes back and hits that original stop loss at 125, I'll probably still profit in the trade net, considering I sold half of my calls at much higher prices.
Yep, that's right. So this is a Google March 125, 150 bullish risk reversal, putting on the old risk reversal, about a $2 net debit. That means we're selling the March 125 puts short, and we are buying an equal amount of the March 150 calls. I like this. You're making a directional bet that it's going to go higher. We're financing that with a bet that it's not going to go lower. Sometimes we put on bets like that, like in Microsoft last week. We weren't necessarily thinking that Microsoft was going to go higher. The bet was more, it was going to stop going down, was more the bet. In this case, that's not the bet. In this case, we're betting it's going up, right? And we're betting it's going to stop going down.
Yeah, in this case, we are bullish on Google. If the market has found its footing here and it's signaling to us that the all clear signals ahead, which, I mean, this week feels like a change of character, JC. It feels like the correction may have run its course. We could be wrong.
I don't buy it for a second. It's going to keep churning. You said it yourself in the meeting today that you think it's going to keep.
Churning is fine. But if the floor has been put in, eventually, when the market finds its footing again, Google is sending the signals that it's going to be one of the leaders, and this is why we're positioning in March to give us some time for that to play out.
Here's the thing, Shawnee, baby. Here's the thing. I think the market continues to be pretty messy, maybe the next several weeks, a month, a more. These are the March options. That's the underrated beauty of this trade. Hello? We're talking about March. Like, we're talking about like March Madness, like St. Patrick's Day. Like, think about what we're going to be doing in March, getting ready for baseball season. Like, it's so far away. The Super Bowl will have been long gone by then.
It's 3 seasons from now. The Dolphins will already have lost in the playoffs by then. It'll be a long time from now.
Stop it. Here we go. Anyway, I like this trade for a lot of reasons. For sure, we're talking tech, we're talking growth. There's kind of like this like underlying backdrop thesis that we have where you could see some rotation to communications over tech, which we've never seen before since the communications ETF was created, which would be interesting. And that's sort of perhaps a larger tailwind for Google. And this is just one way to express that thesis. People who don't trade options, that's fine. The levels remain the same. If I were trading the common stock, I would use that 125 as a stop. If we're not above that, I don't want to be long, right? So that, there's something for everybody here. And if you just want to buy the calls and pay up, the 750, knock yourself out. If that's what makes it, if that's what keeps it groovy, do it. And then if you want to finance that like us and not want to lay out 750, sell the puts and help pay for most of that. I mean, again, there's a lot of different ways to take advantage of this. Perhaps a communications ETF with a lot of exposure to Google, right? There's a lot of different ways This is just one way. It's a very inexpensive way. Like I said, we're financing, and it's a very easy trade. It's not complicated at all. And, Sean was mentioning earlier, he's got the stats, but, we have a nice track record historically with risk reversals. Not that that means anything in this particular situation. um, but
Nope.
hey, it's a trade that we like to put on, and this is a good use case.
Yeah, our experience has been that when risk reversals do work for us, they work very nicely. So that
Well,
that's
they're
that's it.
supposed to. That's why they're trades that they're either not going to work and we're going to know pretty quickly, or they're going to really, really work. I mean,
Yep.
that's why
Yep.
we put on this particular trade. If we didn't think it was going to go higher, we would have put on like a call spread or something,
Yeah. All right.
Like,
Look, if anyone wants to talk bullish risk reversals with me and JC at the Future Proof conference in a couple of weeks, come hit us up. We'll talk to you about risk reversals all night long at the bar.
is it my favorite trade, Sean? You guys always make fun of me, but it actually do. It probably is.
I think it's your favorite trade. At least it's the one you get most excited about whenever we put one on.
I don't know. I seem to get really excited about selling puts in Berkshire when we do that. I
Uh,
get pretty stoked about that one.
that's true.
I don't
I've been
know.
keeping an eye on that one, but I haven't seen any good setups.
I couldn't have put it better myself. It just hasn't really set up, which is really interesting. All right, guys. Again, bullish risk reversal on the Goog. These are the March 125, 150 bullish risk reversal, $2 net debit roughly, selling the March 125 puts and buying an equal amount of the March 150 calls, roughly a $2 net debit. I like this trade. I'm JC Peretz. This is Sean McLaughlin. This has been our options trade of the week. See you next week.
See you, everybody.
See you in Huntington Beach too. Hell yeah.
Woo!